Hi everyone, welcome to this week's lecture on stock valuation. So what we're going to do is we're going to extend the model that we have been working with for the first 2 weeks of this course, and we're going to impose additional structure so that we can make predictions about stock prices and also specifically how it relates to earnings per share and PE ratios. Okay. And so what we're going to do is I'm going to first review what we went over for the last 2 weeks, and then I'm going to introduce to you stock valuation. And then formally, I'm going to introduce the dividend discount model, which is an infinite period present value model. And then using that dividend discount model, I'm going to impose additional structure so that we can factor in investments and growth into this cash flow model that we have been learning about for the past 2 weeks. And lastly, I'm going to talk about comparables and multiples. So comparables and multiples are typically used in conjunction with the dividend discount model as a sort of sanity check. So both methods are not perfect, but usually comparables and multiples are used to justify that your modeling is accurate enough. So let's review a little bit what we talked about for the last 2 weeks. So as you recall from last week, we talked about capital budgeting, and the overall big picture formula that we have been working with is just called the MPV model, right? We're just taking the present value of benefits, we're trying to summarize that using some sort of opportunity cost and discounting it back to time zero, and subtracting the costs today and all the costs in the future and discounting it back to time zero as well. Again, using this, some sort of discount rate that we will come up with a theory for later on. Okay. And lastly, we also define what free cash flow is. So free cash flow is specific to, calculating MPV values for corporate projects. Okay. But of course, you can define free cash flow for households and individuals. But the definitions that I've given you last week is specific for corporations, because most of the terms correspond to items that you would find on balance sheets and income statements. All right, so just to emphasize what we did last week, or differentiate what we did last week and what we're going to do today. Last week we talked about free cash flow, and remember, when we talk about free cash flow, we're actually referring to any available cash that can be claimed by any stakeholder of the firm. So that means not only do we have to think about shareholders or stockholders, but we are also thinking about bondholders and creditors. So free cash flow includes both, should also include available cash that should be meant to service debt, but also earnings and that is net of interest payments. That should go to stockholders and other equity type contracts. All right, so we typically refer to the present value of free cash flow as the so-called enterprise value, because we're referring to the entire firm rather than just one part of the firm that's owned by, for example, the shareholders or the equity portion. And so what we're going to do today that's different from what we talked about last week is we're going to discuss how to value specifically the equity side of the firm, or the equity stakeholder, for the equity stakeholders. All right, so we're going to be focusing specifically on what's called earnings or net income. Okay, so let me give you a definition first. So to reiterate, we will be focusing on earnings. And we typically define earnings as equivalent to net income. Okay, they're the same. So net suggests that it's income that has already been adjusted for paying off your liabilities. Okay, so to emphasize, the net refers to adjusting after liabilities. So liabilities just means money that you owe, or after you, specifically after interest payments. All right, and then finally on this slide, let me also emphasize that enterprise value is referring to the value of the entire firm, meaning all stakeholders or owners. All right, so that's what we have learned so far, and we're going to study a subset valuation model of the firm specifically for equity stakeholders, okay, for today. And then we'll come back to how to price the bond aspect or the creditor dimension of the enterprise value next week. All right, so now I'm going to talk about stock valuation. So let me try to first motivate how one should think about approaching stock valuation. So let's first come up with a list of, qualitative aspects that should influence stock prices. All right, so let's come up with a list. So first, if you have some experience in the financial industry, you may have been told by your boss to read a lot of analyst reports. And as you may have noticed, analyst ratings can influence stock valuation. So let's write down analyst ratings. And the reason why analyst ratings may impact stock valuation is because we typically assume that maybe the market isn't so efficient at gathering information through prices, and we may have to rely on practitioners to collect information, to process it so that information becomes more clear. And so whenever an analyst decides to change its ratings, that's going to change the valuation of the firm because it's introducing information that's informative about perhaps future earnings growth. Okay, so just to emphasize, analyst ratings could impact stock valuation because there's going to be perhaps new information. Right? It's resolving unknowns and therefore making things a little bit more certain, and that can impact, the sequence of cash flows that's going to be incurred for the firm, or it could impact the discount rate directly, right? If a firm becomes less risky because there's less uncertainty, and that means that the discount rate could be smaller. So I'm just going to write resolve uncertainty here. So as a possibility, as a channel through which analyst ratings can impact stock valuation. All right, stocks. What other things can influence stocks? I already mentioned, actually, when discussing analyst ratings, the discount rate is going to obviously influence stock prices, right? And as I reiterated several times in the previous week's lecture, the discount rate is supposed to capture your opportunity cost of capital, right? Your opportunity cost of investing, your opportunity cost of consuming something, whatever. It's the marginal, it's the next best investment option, or it could be interpreted as the amount of money it takes for you to part with your money today. Okay, in any case, the discount rate can be impacted specifically from changes in interest rates from the government, right? And so when we talk about discount rates, we typically think about, oh, maybe it's a systematic mechanism through which it impacts firms, right? So if the government decides to, for example, print more money, that's going to impact interest rates for all firms, and therefore the discount rate can become smaller, and therefore all firms seems to be more valuable, right? Because that's going to make the NPV higher. So I'm going to write opportunity cost, and typically we assume that discount rates is associated with interest rates, and that's going to most likely be systematic. Maybe something related, systematic meaning that it impacts all firms, and is mostly driven perhaps by macro causes. Okay, so again, as I mentioned already from discussing discount rates, something else that might impact stock valuation is the current economic environment. Right, so if you think about it, what we'll talk about next week, interest rates is actually a reflection about many things, right? The growth rate of the economy, future inflation. And so if bond traders are trading, are anticipating these changes in the future about the economy, then that's going to be reflected in interest rates, and ultimately that's going to impact the discount rate and ultimately impact your stock valuation. Okay, so at the end of the day, these are just many things. There's really only two things that really matter. One is whether or not there's new information coming out, right? And that really ultimately depends on people's expectations and uncertainty. So stock valuation, at the end of the day, it's just worth what people think it's worth. So sentiments. So I'm just going to write it's worth what people think it is worth. Okay, and this is capturing expectations about future economy and uncertainties, whatever. And also whatever people think about the future growth path of the firm, right? So I'm just going to write future growth of the firm. All right, so as you can see, there's many ways in which stocks can be changed through uncertainty, new information about the firm, or macro effects, and so forth. And so what we need to do is kind of impose a little bit more structure to give us a method, a framework to think about stock valuation to make it a little bit easier for us, right? We don't want to have too many switches and knobs and so forth that makes the model too complicated. We need something a little bit more tractable, and what we're going to do to slowly ease you into the dividend discount model is start from the MPV framework that we know and that you should know fairly well by now, and we're just going to continuously add a little bit more structure through the slides I'm going to present today, such that it becomes tractable. You can literally find information from the balance sheet and income statements of these firms, and eventually substitute these numbers back into the model to get a pricing model. Okay, that's our task today. All right, so learning objectives. The goal is to learn how to value stocks, and we're going to value stocks through the so-called dividend discount model. And as I mentioned already, it's a general framework derived from the MPV model for thinking about how to value stocks. And the way we're going to approach this is we're going to take the MPV model and then somehow model in investments and growth, okay? And then show how this model is ultimately related to a very popular ratio that you most likely seen in your other courses or in the news, is the price to earnings ratio. And then I'm going to prove to you through our model that we're going to learn today that it's going to be related to growth prospects of the firm. Okay, so in other words, we're going to learn about the relationship between PE ratio and the cost of equity, or the discount rate for equity shareholders. Okay, and finally, by the end of this lecture, I will talk about stock multiples, or they're just other ratios to summarize the performance of the firm. And this technique is literally just finding a counterfactual for the firm that you're trying to analyze. For example, suppose you want to for example, suppose you want to derive you computed, for example, the price to earnings ratio of a firm you're trying to value, but you want to know if this firm is underperforming or overperforming. You would compare that to a subset of other firms that have, perhaps within the same industry that looks similar in a specific dimension. Okay, it's just a sanity check for you to make sure that your valuation model doesn't give you really outlier answers, right? All right, so let's move on to an example. All right, so let me read the example first, and as we read, I will try to give you a little bit of institutional knowledge, and then I will introduce to you some definitions that are relevant to stock valuations. Okay, so in the first bullet point, it states that we're only thinking about buying and selling a stock for one period, so specifically for 1 year. So that means we're going to make an initial investment today, and then we're going to sell that investment in the stock the following year. Okay, so first bullet point, you plan to buy a stock in 3M, and we're going to hold it for 1 year. So to give you a little bit of background, 3M is a conglomerate in the United States. It manufactures not only Scotch tape and office supplies, but also produces medical devices. Okay, they have over 50,000 products essentially. So it's a huge conglomerate. All right, at the end of the year, you expect the stock price for 3M to be $86 per share. The stock will also pay a dividend of $1.92 per share at the end of the year. Investments with equivalent risks have an expected return of 12%. So that is our discount rate that we're going to use. So for now, just take it as a given. We will eventually derive a model to come up with this opportunity cost of capital for equity stakeholders. But for now, just take it as a given. So the question I pose for you is, what are you willing to pay for the stock today? All right, so what this question is basically asking from the framework we learned from last week is we're asked to calculate the present value of this stock, assuming that we can sell it at $86 in the future, but we also get a cash emission of $1.92 per share. All right, so it should be fairly easy to calculate the price of the stock. We simply, again, discount future cash flows back to time zero using the cost of capital that we are given in the fourth bullet point. All right, so let's write out the price formula for GM for today. So today's price is equal to, I'm going to use P naught to indicate that we're solving for the price at time zero, or today, equal to the dividend payment of this stock 1 year from today, plus the price of this stock 1 year from today. Remember, we are selling this stock 1 year from today, and we are also assuming that we receive dividend or cash emissions from holding onto this stock 1 year from today. And because this cash is 1 year later, we have to map it back into time zero to get the present value. And we do this by dividing this future cash flow by 1 plus the cost of capital for equity stakeholders, which is 1 plus 12%. So I'm just going to write 1.12. And that's going to give us a price of 3M for today of $78.50. Right? So not too bad, right? For one period model, it can, once you have a forecast of the future price plus the dividend payments ahead of time, we should come up with a number for the price. Of course, it's not going to be that simple, as you will see that dividend payments, if you hold it for more than 1 year, we have to come up with a model to project dividend payments over several periods. We also may need to come up with a model to project the price levels over several periods. But once we think about stock prices in using the formulas we learned from last week, you'll see that we can kind of actually ignore modeling P1 and just focus on the dividends. And we'll eventually see that in the next few slides. All right, and one last definition. I want to give you some definitions so that when I mention these definitions, they shouldn't be surprising to you. So a typical terminology or something we calculate in practice is called the dividend yield. The dividend yield is defined as DIV, the 1 year dividend payments divided by the price of today. So in this question, that's 1.92 divided by 78.50, and that's gonna give us 2.45%. Okay, that's just a definition. Okay, you just memorize it. All right, and the percent change in the price, we also typically have a term for that. That's called the capital gain rate, or more precisely, the stock return. Capital gain rate is equal to P1 minus P0 divided by P0, right? Just the change between the price of 1 year from today and the price of today divided by the price of today. And that's going to give us 86 minus 78.50 divided by 78.50. That's going to give us 9.55%. Okay? And just to make sure we are on the same page, capital gain rate does not account for dividends. Okay? Just notice. Does not account for dividends. All right. Now, let's review the formula that we applied in this example and then show you how the cost of capital is related to these two definitions I gave you about the dividend yield and the capital gain rate. So what's the relationship between the cost of capital and the capital gain rate in the dividend yield? And we can actually see what this relationship looks like by just writing out this present value formula that we applied in example 1. So if you recall from what we did in the previous slide, we used the following formula. P naught is equal to the dividend payment 1 year from now plus the price of the 3M stock 1 year from now divided by 1 plus RE. I'm going to use RE to denote the cost of capital for equity stakeholders. Let's rearrange the terms now. So let's multiply both sides by 1 plus RE. We will get P naught times 1 plus RE equal to dividends 1 year from now plus the price of the stock 1 year from now. And then let us divide both sides by P naught. Okay. We will get 1 plus RE equal to dividend 1 year from now plus price of the stock 1 year from now divided by P naught. Okay. Now subtract 1 from both sides and we should come up with an expression with the cost of capital on the left-hand side and everything else on the right-hand side. So RE then is equal to dividend 1 over P naught. We can separate this because the fraction above, the numerator above is a sum, and so we can split this fraction, and the fact that we subtract 1, we can combine that with that other fraction, and we should get P1 minus P naught divided by P naught. And everything should look familiar now, right? The left hand, the first term of the right hand side is the dividend yield. And the second term in the right-hand side is the capital gain rate. So actually quite intuitive, right? So the cost of capital is actually what we perceive as the dividend yield plus how the future evolution of prices. And if we impose, a little bit more structure, we can actually rewrite this cost of capital simply as a function of how the dividends evolve over time, right? We can actually think about prices, the evolution of prices in terms of the dividends, okay? So what I want to do eventually is to find a way to substitute P1 or P1 minus P naught over P naught with something, okay? And we can actually do this with this recursively using this expression here, right? So what we can do is continue substituting P1 with, with the next iteration of dividend payments plus future prices. And if we keep substituting P1, P2, P3, and so forth infinitely, we can actually rewrite the cost of capital as a infinite sum of dividend payments. Okay, and I will show you that how it's done, and that's how we will arrive at the dividend discount model. Okay, so for example, we can define P1 in terms of dividend payments in 2 years from now, plus the price of the stock 2 years from now divided by 1 plus E, right? So we're only discounting back to time 1. If we keep substituting P1 into our cost of capital equation here, and then we continue to substitute for P2, right, and so forth, P3, we will arrive at something that looks like an infinite sequence of dividend payments. All right, so let's move on to formally show you how the dividend discount model is achieved. Okay, so as you know, we only looked at a 1-period models, and we can now extend it to several periods. And that means that we have to think about, okay, if we decide to do this, we're actually thinking about holding on to the stock perhaps more than 1 period. Okay, but that's okay. Our task right now is to come up with an equation that removes prices out of the equation, out of the pricing formula. Okay. All right, so recall from the previous example, we had a 1-period model, right, in which the price today at time 0, P0, is equal to dividend payments 1 year from now plus the price of the stock 1 year from now, discounted at 1 plus RE. But we also have a recursive formula for prices, right? We can actually write P0 for P1, right? In the same way, dividend payments the next year plus the price of the stock the following year divided by the same discount rate. Okay, so let's try substituting P1 into P0, and we should get the following form. So let me do that now. We should get div1 divided by 1 plus RE plus div2 divided by 1 plus RE squared plus P2, 1 plus RE2. Okay, so you kind of already see what's going to happen once we continue down this line. We will eventually have an infinite sequence of dividend payments, and P2, if we go to infinity, P will just keep being substituted over and over and over again. Okay, and so if we take it to the limit, we should actually just get an infinite sequence of dividends, assuming that the dividend payment starts 1 year from today. So div t, so the subscript t indicates time, divided by the discount rate. Okay, and if we want, for example, if we want to separate this into an arbitrary cutoff, we can just choose, for example, 5 years, just to model the dividend payments perhaps for 5 years. We can. Suppose that's the only known information. Then we still have div t divided by 1 plus RET, but we also have a final price term, right? But just note that this term here is actually just another infinite sequence starting at year 6, right, of dividend payments. This is t minus 5, right? Any case, this is just showing that once we continue to substitute prices with the recursive price formula, when we take time to the limit to infinity, we should simply just get an infinite sequence of dividend payments, and therefore future prices of this underlying stock is fully characterized by the future dividend payments of the stock. Okay. So what I just wrote is simply reiterated in this slide again. So again, the price of the stock is simply an infinite sequence of dividend payments of the firm. Okay. So the question you should be asking you is, so is this model really helpful for us now? So that's what I asked for you in slide 12. Is this model useful? Well, formulas are typically useful when you can actually find information and substitute those information into the formula and then spits out something that's, meaningful. But not all stocks pay dividends, right? And that's a little bit confusing, right? If you imagine, typically blue chip stocks and, companies that are well established, they do pay dividends because they don't have that much, typically they don't have that much growth. So we'll get to that eventually. We don't always know the dividends, so we do actually have to come up with a model for that. Secondly, as we mentioned already, we don't know the discount rate either, so we'll get to that. But from a qualitative perspective, what I presented here so far is not useful yet, but it's useful in the sense that we can still impose additional structures to still make it useful eventually. Okay. So let me write down what I just said. So how do you know div t? And so we need to model this eventually. And how do you know the discount rate? And we will eventually model this as well much later in this course. So as of now, it's not useful yet, but from a qualitative perspective, I believe, is still useful, and we will see. Okay, so let's move on to a second example, and it's going to be much useful because we're going to now impose additional structures to this dividend discount model, and we're going to do it intentionally to look like something we've seen in the previous week. Okay, and so this is our way to kind of incorporate the growth path of the firm through the definition of what a dividend is. All right, slide 13, we have a second example. We have AT&T, which is a large telecom company in the US. They plan to pay a $1.44 per share in dividends in the coming year. So not this year, but in this following year. The dividends are expected to grow by 4% per year in the future. Okay. So this means that this growth is going to continue indefinitely. So this point should already kind of give you a sense of what we're trying to do. We're trying to actually use a growing perpetuity, right? We're trying to use this perpetuity idea and try to impose it onto our dividend discount model. So start thinking about what a perpetuity is. A growing perpetuity. All right, so the expected return on the AT&T stock is 8%. So this is just saying that the cost of capital for equity stakeholders is 8%. So we're just going to write RE equals 8%. And the question I ask you is, what is the value of the AT&T stock? And can we use this example to come up with a useful version of the dividend discount model? And yes, so we will come up with a useful version by reformulating the dividend discount model with a growing perpetuity. Okay, and so it becomes easier to think about how to model the firm when we give ourselves a more structured parameter. Okay, so let's think about how to first solve this problem. Okay, so as you know, since we are already assuming that the dividend payments are growing at a fixed rate forever, then it should be quite easy to come up with a price for this stock, right? It's simply a growing perpetuity. So let's write out, the growing perpetuity formula, but we're going to substitute out the cash flow with dividends. Okay, so as you recall from last lecture, we have the price equal to the sum, infinite sum, starting next period with a dividend payment, and we're assuming that this dividend payment will grow at a fixed rate, and we're going to discount it by 1 plus RET, right? And as you know, we came up with a reduced expression for this formula, and that is div t divided by RE minus G. Okay, so our div t is 1.44, as we mentioned in the first bullet point, divided by 8%, which is the opportunity cost of capital for equity stakeholders, minus 4%, which is the growth rate, the dividend growth rate. And that should give us a number of $36. Okay, so to answer the second question here, can we come up with a version of the dividend discount model that's useful? Yes. Right, and the idea is that we are imposing additional structures on the dividend discount model so that it's we don't have to actually map out the dividend path. We simply have to define the growth parameter, and that already tells us how the dividends will evolve over time. So let me review a little bit. So we started out with this dividend discount rate model. T equals 1 div t divided by 1 plus RET. And we are going to now model div t as div 1 times 1 plus g. So that's infinite sum, and we're going to write div 1 times 1 plus gt minus 1, okay, 1 plus RET. And just a simple substitution of div t for div 1 times 1 plus g to the t minus 1, we already arrive at a growing perpetuity formula. And we all know what this reduces to because we derived it the first 2 weeks of this course. That's going to give us a price of equal to div 1 divided by RE minus G. And we actually can go one step further, right? We can do the same exercise as we did to understand the relationship between the cost of capital and those dividend yield and capital gains returns, right? Capital gains yield. So let's multiply both sides by R minus G. RE minus G equal to div1. And let's divide both sides by prices and subtract G. We will get div1 over P naught plus G, right? So this is our relationship for an infinite horizon stock path, right? So we still have this dividend yield parameter, but now our capital gains path of the stock is simply represented by the growth rate of the dividends, right? Div growth rate. Okay, so things are much easier now, right? We no longer have to think about the price path. We don't have to run any simulations here. From practitioners, for people working in corporate finance field, we simply have to model G, just one parameter, and that is enough for us. All right, so what we're going to do from here is to continue to impose a little bit more structure on G, and then try to find things on the income statement and balance sheet so that we can substitute those parameters into for G. Okay, and we're going to, in other words, we're going to find a way to decompose G into things we can find on the balance sheet and income statements for firms. All right, so what you should start thinking about is what actually determines G in real life. So what drives the growth in dividends? All right, so this is our now discussion of trying to incorporate investments, earnings into dividends. Okay. So what you should be thinking about, what you should be realizing is that earnings, investments, and dividends are actually part of the same picture. In fact, we can decompose earnings into two parts. So remember, earnings is just net income. So what can you do with net income? You can basically do two things. You can give them back to the equity shareholders, right? You can give them back through dividend payments, or you can retain those earnings and make investments within the firm, so that you can increase the growth rate of the firm in the future, right? And specifically, the growth rate of the dividends in the future. So earnings, let me reiterate, earnings is simply investments plus dividends. Investments means that we keep those earnings retained within the firm, and we use those earnings to buy factories, to hire new workers, to buy more machines, upgrade technologies, so forth, so that the firm becomes more efficient, produces more things, and therefore eventually leads to an increase in the growth rate of the dividends. Alternatively, if you don't reinvest in the firm, then you would pay out those earnings immediately, right, through dividend payments. So the conclusion here is that given this definition, if we don't make any more investments in the firm, then the firm either stays the same and nothing happens, right? But if you want the firm to grow, then the only way to manipulate the earnings growth of the firm is through investments. So that's the intuition that I'm trying to introduce here, and we eventually want to model this mechanism directly into our dividend discount model. Okay, so increases in investments is going to lead to increases in G. Okay, we eventually want to model this mechanism, this channel, into G and show you how that's going to determine the stock price. Okay. So that's exactly what it is. We're just going to find a way to use the tools we learned so far and find a way to show that investments can eventually lead to growth of the firm. Okay. And rather than present to you formulas and so forth, I like to present things with an example so that it kind of gives you intuition, the working parts of the formula. So let's just start out with an example that you can find in your textbook. So example 9.3, we are talking about a company called Crane Sporting Goods, or CSG. CSG expects to have earnings per share of $6 in the coming year. So let me give you the definition of what earnings per share means. So literally, it's just net income divided by total shares outstanding. That's going to give you EPS. And we said that EPS is 6. Okay. Rather than reinvest these earnings and grow, CSG plans to pay out all of its earnings as a dividend. So they're not retaining of the earnings. So based on this second bullet point, what you should be thinking is that, okay, recall the formula that I already introduced to you. If the firm CSG doesn't want to grow, then that means that our parameter that we already know, I've seen before, G must be equal to 0. So no investment implies G is equal to 0. Third bullet point, with these expectations and no growth, CSG's current share price is $60. So let's just assign P naught equal to $60. Okay. All right, so that's our baseline. In the fourth bullet point, the example presents to you a change in its policy, dividend payout policy. So now suppose CSG could cut its dividend payout rate to 75% for the foreseeable future and use the retained earnings to open new stores. So that means that it's going to only pay out 25, or yeah, so it's going to retain 25% and use that 25% to make investments. Okay, just think about we're taking 25% of the net income and we're going to set it aside and let it grow through investments. So that's what the next bullet point states, is that once we take out that 25%, that 25% is going to grow 12%. Okay? In other words, the return on investments is equal to 12%. I'm going to use the variable ROI to indicate that it's a return on investments equal to 12%, and I'm going to use this variable to represent that. Assuming CSG's expected return on equity is unchanged, what effect would this new policy have on CSG's stock price? Okay, so there's kind of a hidden hint here. So if you look at this second bullet, the following bullet point, the above assumption imply that CSG's expected return on equity is 10%. So that means that we should be able to derive the cost of capital based on the information that's given to us for now. And then we can still use that cost of capital to come up with a new valuation for this firm. Okay, so that's what we're going to do. So first step, we're going to figure out how to come up with this cost of capital given the information we're given. And then we're going to figure out how much this firm should be worth given this new dividend payout policy, and then use that the previous cost of capital to discount future dividends back to time 0. Okay, so that's the plan. So recall from the first slide, or the previous slide, we assume that there is no growth. So that implies that G is 0. And we're going to use the cost of capital formula that you saw a couple of slides ago. So RE is equal to div1 over P naught plus G, right? Given an infinite period stock path, we can rewrite the cost of capital simply as a dividend yield plus the projected growth path of the dividends. And given that G is 0, we know every other parameter. Div1 is equal to 6, right? Because that's just simply the earnings per share, divided by its current price, which is given in the third bullet point at P0 equals 60. 6 divided by 60 will give us 10%. All right, so we're going to use this RE to discount our new future cash flows. All right, so to review, what's happening is now the firm is adjusting its payout policy. It's no longer retaining all of its earnings. It's going to pay out 75% of it. So let's write that down. So new policy. It's going to have a new div1. So I'm going to write div1 prime to indicate that it's a different div1, right? It's an adjustment. So div1 prime is equal to 75% times the EPS, right? The overall earnings of 6. And that's going to give us a dividend payout of only 4.5 now rather than 6. And what the company has decided to do is they're going to retain 25%. So I'm going to write CSG reinvest. I'm going to use B prime to indicate that it's a different earnings retaining policy. So B used to be 0, now it's 25%. So B prime is equal to 25% of its earnings. So we're going to set aside those earnings, and we're going to make CSG is going to make a new investment. And this new investment is expected to generate an ROI, or return on investment, of 12%. All right, so the overall growth rate should be quite clear, right? It's simply the percent of the dividends that's set aside to be reinvested, and then we multiply that subset by the ROI of 12%. The growth rate of earnings and dividends will be G prime, again prime to indicate that it's a change in the parameter that we already have, equal to 12% times 25%. And this will give us 3%. Okay. Assuming RE does not change. Remember, RE is our opportunity cost of capital for equity stakeholders, or the minimum amount of money that's offered to you to part with your money today. We can use the constant growth formula. So that is equal to P naught equal to div1 prime divided by RE minus G prime. All right, now we just substitute those parameters that we derived. So it's 4.5 times 0.1 minus 0.03. That's going to give us 64.29, and it's going to be greater than 60, which is the currently traded stock price. And remember, all we used is imposed some structure on the dividend, the path of the dividend payments over time, such that it's just a representation of some constant multiplied by 1 plus the growth rate, then we can simply use the growing perpetuity formula for our pricing model. So this is just a growing perpetuity. Okay, so what we have essentially done is now found a way to incorporate the mechanism through which investments can lead to changes in the growth rate and therefore impact the price of the stock. Okay, so over the next few slides, we will go ahead and try to formalize this relationship. And again, try to provide you with as much intuition as possible and how to relate this to a common ratio that you've seen in newspapers and so forth, specifically the price-earnings ratio. Okay, so let's talk about first the price-to-earnings ratio, and it will be clear what this ratio represents and how it relates to this growing perpetuity model that I've shown you here in this slide. All right, so let's look at what PE ratio means. So PE ratio just means, by definition, the current price per share, P naught, divided by the earnings per share. Okay, so P stands for the price per share, PE stands for earnings per share. So I give you two companies here just to explain kind of the intuition between PE ratio and what I presented so far. Okay, so for Amazon, the PE ratio for these numbers, I think these were a few years ago, the Amazon PE ratio was 68.64. Conversely, for GM, the price per share divided by earnings per share ratio is only $17.87. So why is there such a big difference? So for those of you who kind of trade stock, you realize that GE, I think GE pays dividends, but Amazon, they're essentially reinvesting all of its dividends into its stock. It does not emit any cash. And so what does this mean? This means that GE has less, from what I've presented to you so far, is that GE actually, from our model, has less growth opportunities. Or in other words, Amazon has a lot of growth opportunity. Okay, so I will eventually show you that the PE ratio will say something about growth, which is growth of the firm, specifically through investments. So GE has less growth opportunities. Okay, so our goal now is try to understand the relationship between stock prices and earnings by deriving a formula for PE ratio that is a function of expected return on equity, or specifically that is our RE, and also a function of ROI. Okay, so in other words, we want PE as a function of RE and ROI. Okay, so let's start doing that. Let's try to build a relationship between prices and earnings through these two variables that we've seen already. Okay, so let's use some notations first. So far you should be familiar with div and EPS. So div, I'm just going to represent dividends per share at the end of year T. EPS is earnings or cash flow from operations per share at the end of year T. IMV is a new parameter I'm introducing, and IMVT represents new investment per share at the end of year T. And so earnings are either paid out as dividends or investments. So you can think of EPS simply as div dividends plus investments, or div t plus INVT. This is div t plus INVT. Right? Or equivalently, if we want a formula for dividends, since we are working with the dividend discount model, we can rewrite dividends in terms of EPS t minus INV t, or investment t. Okay, so that's exactly what we're going to do. We're going to start with the dividend discount model. We're going to substitute div with EPS minus investments, and we will eventually arrive at a relationship for PE ratio and RE and ROI. So let's get started. On slide 22, let me write out the dividend discount model for you first. So P naught is equal to the infinite sum, starting from time equals 1, dividend payments T divided by 1 plus the opportunity cost of capital for equity stakeholders, T to the T power. Okay, we're going to substitute div T with our previous definition between investments and EPS. Okay, and we arrive at this following equation. And we know that since the numerator is linear, we can separate this into two fractions. So T minus 1, we have EPS T divided by 1 plus RE T plus minus the sum T equals 1 to infinity investment T over R plus E T. Right? Sums are linearly separable, so we can actually, that's why we can group terms together, right? All right, so if investments is 0, that means that the firm decides not to reinvest any of its EPS in the firm. So investments is therefore 0. In that case, our price of the firm is simply an infinite sum of earnings per share every period. And that's going to give us a very simplified expression, right? In the case in which EPS stays constant year after year, we can just write all EPS T equal to EPS 1. So we are setting EPS T equal to EPS 1, right? Because no growth in earnings per share, we assume it stays constant given no investments. And so our pricing formula simply reduces to a perpetuity, right? A constant perpetuity, right? And that's the expression we derived last week. And so if we were to rewrite this expression in terms of its PE ratio, so that's P naught divided by EPS, right? That's our PE ratio. We should get 1 over RE. Okay? So we have, therefore, in the special case in which investments is 0, our price to earnings ratio is simply the inverse of the opportunity cost of capital for equity stakeholders. And you'll see that this actually corresponds to calculating the PE ratio directly from the CSG example. So if you recall, the PE ratio in the CSG example was $60 per share divided by 6 before their dividend policy change, payout policy change, which is equal to 10. And that's going to be equal to 1 over RE. And recall that the cost of capital before the dividend policy change was 10%. And 1 over 10% is going to give you 10. So it is internally consistent. Now let us add some growth to the equation, and we're going to try to look at the P/E ratio for a CSG, assuming that it does invest. Okay. In the case in which CSG does invest, we already calculated the new price of the firm, right? Which is I'm going to use P naught to represent, sorry, P prime to represent the new price that we calculated. And that's going to be equal to 64.29, if you recall, divided by 6. 6 is the earnings per share. And if you work this out, obviously, it's going to be greater than 10. And so how does this formula relate to what we derived in the previous slide? So if we include growth or reinvestments in the firm, then the price of the company is actually EPS 1 divided by RE, or the price of the firm without growth, plus the present value of growth opportunities. Right? That's the only way in which we get a higher value of P, right? As I showed you in the limiting case in which investment is 0, we have the firm by itself without any growth. That's simply just EPS 1 over RE. Okay, so if we were to rewrite this price formula in terms of P/E ratio, we simply just divide everything by EPS. So P naught divided by EPS 1 is equal to 1 over RE plus PV, growth opportunities, divided by EPS 1. Okay? So this is what we saw in the previous slide, and this is showing that the P/E ratio is definitely capturing the baseline firm without any growth plus growth opportunities. And we learned from the previous example that growth opportunities can only come from investments. That is an assumption that we made by choice, right? We wanted to make it so that growth is a function of investments, and that's the mechanism through which we want to augment the dividend discount model so that we can price firms with a more tractable model. Okay, so to emphasize again, in the CSG example, what was driving the growth of dividends? It is through investments. Okay, again, this is by construction. All right, this is by construction. It is because we intentionally imposed additional structure on the dividend path, right? And also we are also assuming that the growth rate is a function of investments plus retained earnings. Right? There's two layers of assumption that I kind of didn't emphasize, but that's what's going on. We are taking the dividend discount model, augmenting it such that we can model the dividends in terms of a simple growth constant, and then assuming that the growth rate can be redefined as a function of investments plus retained earnings. All right, so let's re-emphasize what we've done with a little bit more mathematical formulas and rigor, and then I will give you a more straightforward explanation using an example. And I think then it'll be much clearer what exactly we've done so far. All right, so what we have done, or what I want to do, is to assume that any change in EPS, in earnings per share, must be due to the change in investments. Okay, so that's what this first formula is saying. Okay, so let me write this up here. Assume any change in EPS must be due to our ROI or retained earnings. Okay? Or in other words, I can write this recursively. EPS2, the second period's EPS, is equal to the previous EPS plus how much I decide to return as investments times our ROI. Okay? And so if you use this equation here, you can actually arrive at the same equation. I'm simply moving EPS1 from the right-hand side to the left-hand side. And that's how we get a difference between EPS t plus 1 minus EPS t. Okay? And all we're left on the left-hand side is just investments or retained earnings times return on new investments, or ROI. Okay. Now we can go one step further to give us a little bit more realistic parameters. So we can actually take investments and redefine it as a function of EPS. As I said, you can rewrite this as retained earnings. And so let's go ahead and do that. Investments is equal to EPS times the retention rate, or the percent of the EPS that you would like to retain to grow the company. All right, so once we have this investment definition, we can substitute this above here, right? And then we can divide everything by EPST. So let me show you what goes on after we take substitute investments into the first equation and divide both sides by EPST. So what you will get is change in EPS. So change is just the difference between future and present EPS divided by the current EPS. Let's write EPST equal to EPST times B times our ROI, right? Because we substituted investments here into the above equation there. And since we divided by EPST, the EPST cancels out. So all we are left is B times ROI. And we all know what B times ROI is. It's simply G, right? The growth in earnings rate is equal to the change in earnings divided by earnings, which is equal to B times ROI, or the retention rate times ROI. Okay? All right, so before we move on to the next detailed example of what the growth path of the firm looks like if it decides to reinvest through retained earnings, let's talk about how to decide whether or not a firm should choose to retain earnings, which can lead to a change in ROI. Okay, so in other words, how does this relate to the MPV rule in making decisions whether or not to pursue some sort of investment that corresponds to a different ROI or higher ROI? So let's talk a little bit about that. So the question I should be asking you is, how is this related to the MPV rule? So in other words, when should firms choose to invest in generating new earnings, right? In other words, when should they retain their earnings rather than pay it all out to their shareholders? So maybe rather than asking this general question, we can just go back to the example of CSG. What if CSG's ROI, or return on investment, was instead 8%? should it still invest 25% of its earnings? So if you went through and did the math, you can. So I'm just going to tell you the answer now. The answers are no. And you'll see that the NPV is actually negative. And I'll show you now how we can easily show that it's true. So NPV, what is that? NPV is simply the present value of the benefits minus the present value of the cost, right? So the NPV of new investment is equal to, in the CSG example, or in any stock example actually, it's assuming infinite periods, it's simply just the growth rate of the dividend earnings payments divided by the discount rate, right? It's a perpetuity. It's a growing perpetuity. So that is investment T times R ROI divided by RE, right? Minus, this is the present value of benefits, minus investment T. This is the present value of costs, right? And so we would choose to pursue this new dividend payout policy or earnings retainment strategy if the present value of the benefits exceeds the present value of the costs. So things become much more clearer when we group this together and factor out investments. RROI minus RE over RE. So as you can see, if the investments return on investments is greater than the cost of capital for equity stakeholders, then it will generate positive NPV. But in our case, for the CSG example, we know that if our ROI is 8% and RE is 10%, the difference in this numerator will actually be negative. Of course, this is all assuming that investments leads to a permanent increase in earnings. Okay. So let's go to an example. So what I will do is I will actually present you an example of a new company that's going to go through a growth phase where it's going to retain some earnings, and it will grow up to a certain point, and then it's going to change its policy because its ROI will change after a certain investment size. Okay, so that's kind of the big picture of what's going on. And the idea is we're going to try to calculate the PE ratio of this firm based on this growth path of the firm that we decide to model. Okay, New Ventures Incorporated, example 4. Just to summarize, this is just an equity valuation of a firm with new investment opportunities, but there's conditions. So this is equity valuation with new investment opportunities. So New Ventures Incorporated expects to generate total earnings of $50 million in year 1. Okay, so at the end of year 1, it will generate total earnings or net income equal to $50 million. If there is no further investment, we assume that NVI will continue to generate $50 million a year. Okay, so there's a hidden, again, as I mentioned earlier, there is a hidden assumption here. This is assuming, this implies that the change in EPS must be due to investment. Okay. As a young firm, NVI has very valuable investment opportunities that yields ROI of 50%. So that means that if you allocate, $1, you get your dollar back, but you get 50 cents more. Okay. So, but there are conditions here. The condition is that NVI can only invest up to $600 million in aggregate. Afterwards, if you invest any additional more money, you will only generate an ROI of 7%. So as you learn from the previous slide, 7% may not generate positive NPV. So we have to know what our cost of capital is to figure that out. So let's look at the second slide. Like most young and entrepreneurial firms, NVI plans to plow back. So plow back just means retain 100%. So B equals to 100% until total investment reaches $600 million. Okay, so that means it's going to keep all of its earnings and put all of its earnings into this investment opportunity. So, and they're going to keep doing that until 600 million is reached in aggregate, cumulatively. And then after that, it's going to pay out all earnings as dividends. Given the required rate of 8%, so as you know from the 7% ROI in the previous slide, we know that continuing to invest in this project will be unprofitable, or it will yield negative NPV. So that's why it will pay out all of its earnings after it reaches the 600 million target. All right. So what this question is asking you, what is the P/E ratio for NFI? And yeah, so let's map out what this growth path of this firm looks like over each year. And we will decompose earnings into its investment component and its dividend payout component. So just to review some definitions, equity firm value simply means the price per share, P0, times the shares outstanding. Total earnings equals to the earnings per share, or EPS, multiplied by total number of shares outstanding. And total dividends is equal to dividend per share times total shares outstanding. Okay, so hopefully that's just a review, and you've read through the textbook, or you learned it from previous courses. All right, so what I'm going to do is I'm going to map out a table to show you the evolution of the earnings growth over time, of its investment size over time, and its dividend payout over size. And I'm going to keep track of its cumulative investments to show you what exactly happens after it reaches the 600 million aggregate cumulative target and switches from investing to full 100% payout of its earnings as dividends. So therefore, I will have 5 rows. Okay, so 5 columns. The first column I'm going to have is time. Let me leave myself some space here. So time, and then the next column it will be earnings. And as we all know, earnings can be decomposed into 2 parts. It can be decomposed into investments. Let me just use total investments. Okay. And plus dividends. Okay, and I'm going to keep track of cumulative investments in the last column. So let's begin. In the first year, we know from the first bullet point in slide 27, New Ventures expects to generate total earnings of 50 million. Okay, so after the first year is when it decides to invest in this new profitable project through and finance through earnings. So first year we have earnings of 50 million. I'm going to skip the million part, and that's going to be reinvested. Right, so investments is going to be 50 and no dividends because we're keeping all of its earnings as investments, and that's going to give us $50 million cumulatively so far. In the second year, we will start getting returns from the new profitable investment opportunity. So we will not only get 50, but we will get 50% back as well. So 50 plus 50 times 0.5, right? That will give us 75. And following its policy of full plowback or full retainment of its earnings, 75 will go into investments, 0 will go into dividends, and therefore the cumulative investment will be 50 plus 75, which is equal to 125. Okay, so I'm just going to do this quickly because I don't want to recite all of these numbers. So the third year we will get 75 times 1 plus 0.5, right? Equal, I'm rounding here, so I'm going to write 113. And all of it goes into investments, and cumulatively that's going to give me 125 plus 113, 238. Okay, and the next period we will grow our earnings again. 113 times 1 plus 0.05, which is equal to 169, and 169 will go into investments, 0 everything else for dividends, and our cumulative number will be 406. Okay, and yeah, that's the fourth period. Fifth period is where we will actually hit the 600 million target for our cumulative investment. So we will invest we invested 169, which will generate a return of 50%, and our earnings will be 253. But we won't invest all of it because we can only invest up to 194. So as you know, 406 plus 194 will give us 600. So we will hit the cap, right? And so 194 is how much we will invest. And the rest is 253 minus 194 equal to 59 dividends. $1 million of dividends. Okay? So we already started paying dividends in year 5. In year 6, we get 253 plus only 50% on 194, right? Because of the previous period. And that's going to give us 350. Okay? And starting in year 6, we will no longer invest because we hit the cap last year, the previous year. And therefore our dividends will be 350. We will emit all of our earnings back to the shareholders because we have already hit the 600 million cap. And so for 7 and 8, we will have 600 because we're no longer investing, and we will still generate 350 million earnings per period, but we won't be making any investments, and so we will just emit all those earnings back to the shareholders. Okay, so just to remind you, the model that we are using here is EPS T plus 1 equal to EPS T plus investments T R ROI. Okay. So what we have done in the big picture is we've actually mapped out the growth phase of the firm. The growth phase is from year 1 to year 5. And for 6, 7, and 8, and so forth, we have a mature phase. Great. All right. So I think things should look fairly straightforward given this example, because we literally see step by step, year by year investment returns, and we know how the firm decides to retain, how much of the firm decides to retain as of its earnings, and use that earnings to make investments, and when it stops to make investments, and what happens to those earnings after the growth phase, right? All right, so let's answer the question posed on slide 28. What is the P ratio of NVI? So as you know from the previous, from the table I outlined, the first dividend payment occurs in year 5, and we see that it pays out $59 million. After that, dividends become constant at 350 for all time. And so from the dividend discount model, we know that the firm is equal, the value of the firm, the equity side of the firm, is equal to simply the sum of all future dividends discounted by the opportunity cost of capital for equity stakeholders, right? So the first emission or first dividend payment is $59 million, which occurs in 5 years. So that's what occurs here. But for the rest of the years beyond year 5, we know that the present value of that constant perpetuity is 350 divided by the discount rate of 0.08, right? So 350 divided by 0.08 from the perspective of assuming we are in year 5 is 350 over 0.08, and discounting that back to time 0, we simply divide 350 divided by 0.08 divided by 1.08 to the 5th power, and that gives us a firm value, equity firm value of $3,018 million. So the P ratio, it's just equal to the market cap divided by total earnings, is 3,018 divided by 50, which is equal to 60. So what the takeaway here is that growth strategy impacts P/E ratio. All right, so that concludes our introduction to stock valuation using the dividend discount model. So just to review a little bit, what I presented to you was something we've seen before using the NPV valuation, but we imposed a little bit more structure, right? We first introduced the dividend discount model simply as an infinite sum of cash flow payments, which we call dividends or earnings, and we simply model dividends in terms of growth, right? We just assume that dividend payments can be thought of as a fixed payment constant into perpetuity, but we can actually adjust this dividend payments into the future as a growth path, and that's why we get the G parameter in our model. And then we further impose structure onto this model by assuming that growth can only be driven by retained earnings or investments in the firm, right? And that gave us a little bit more structure and ability to infer parameters through real data. Okay, so obviously when you think about the growth path, we can now think of it simply as investment patterns, right? If you think firms are investing steadily year after year and the pattern is consistent, we can simply just model that directly now into G, right? And it's much easier, tractable for us now. So what I want to conclude this lecture by talking about a sanity check to our dividend discount model. So I want to introduce the concept of multiples. Okay, so the idea is quite simple. We want to think that we can compare firms to other firms given similar characteristics, and this helps us double check that the valuation we come up with the firm is not completely completely outside of our reality, right? So we kind of want to ground our model with some facts that we can actually infer from other firms. Okay, the idea is quite simple. Actually, we've discussed one of these ratios called the PE ratio. So the PE ratio is one popular multiple. But again, a caveat to the PE ratio is that it only applies to the equity side of the firm. So recall that P stands for price per share of the equity stockholder, and E stands for earnings per share. Okay, so earnings and price are both net of liabilities. So it's important to think about, when you think about multiples, when you construct one, to make sure that the numerator and the denominator are both talking about the same parts of the firm. Okay. So I'll give you some examples here in the next few slides. So another typical, when you think of an example of a firm multiple, so we're just talking about stock multiples, but a firm multiple, we are literally talking about the entire value of the firm. That includes all stakeholders, not only just the equity side. So we typically use enterprise value as the numerator when talking about these multiples or fractions that compares the value of the firm to some characteristics. So for stock multiples, the PE ratio, P stands for the value of the firm, the market value of the firm, but earnings is some characteristics of the firm. But we have to make sure that the numerator and the denominator of these multiples have to be discussing the same parts of the firm. Okay, so to summarize, multiples, what it really means is just a ratio between a measure of the firm's value or part of the firm's value divided by some firm characteristic. So the firm characteristic can be anything. It doesn't have to be some accounting variable. It can be like firm age, for example. It can be CapEx, for example. It can be the number of employees. It doesn't matter. The idea here is that firms operating within the same industry who have similar, perhaps leverage ratio, blah, 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 they should have common, very closely similar multiples, company multiples. Perhaps not stock multiples, but maybe enterprise value multiples. All right, so let's think about, so let me be clear what I just said by writing out some formulas. Okay, so we talked about stock multiples, but let's talk about firm multiples in general. So firm multiples, we're talking about the entire value of the firm. And stock multiples, equity multiples, is when we're only talking about the equity side of the firm, the equity value of the firm. So when we talk about firm multiples, the numerator is a measure of firm value, and we typically use enterprise value because it represents the value of not only equity stakeholders, but also creditors and bondholders. And a multiple by definition is simply just taking the ratio between firm value and some firm characteristic. Okay, so an example would be enterprise value divided by sales. All right, equity multiples. You already seen one called price to earnings ratio, but to generalize that into a formula, it's simply the equity value divided by firm characteristic. And as I emphasized, when we talk about the entire firm, we have to ensure that this firm characteristics can be claimable by all stakeholders. Okay, so sales is essentially revenue, and all stakeholders can make a claim on revenue. It would be incorrect or it'd be misleading if you were to use equity multiples and divide equity value by sales. Okay, it would be problematic. So in other words, firm characteristic for equity multiples should be net of liabilities. So based on my opinion and what I've seen in practice, enterprise value firm multiples tend to be most robust. As you can imagine, equity multiples can be problematic because you can mechanically increase your equity value through leverage, right? And it can be misleading. Whereas firm multiples, leverage value is incorporated into firm value, and it's much more robust. Okay, and yeah, and it should be less volatile compared to equity multiples, as you can imagine. Equity multiples is can be the market value can fluctuate a lot, whereas firm value it's usually typically has some book value, which is tend to be stable over time, and so it's tend to be preferred. But in any case, let's talk about how to make comparable valuations. So I outlined the methodology here in 4 steps. So typically what you would do is you would find a set of firms that are roughly similar. So examples of what you could do is you can match firms based on age, based on industry, based on products, whatever you want. And what people usually call this set of firms is comps. So for example, if you're evaluating Microsoft, a comp would probably be like Apple, right? Because they make software, they make hardware, they make consumer electronics, whatever. And any other hardware making company could also be considered a comp. All right, so for each comp you can derive a ratio. So in this case, in step 2, I propose that you can use the price to earnings ratio. So in the case of Microsoft, if you're using Apple computers, you can calculate the PE ratio for Apple. Okay, and you can, for example, you want to use AMD, to represent a comp as well. You can also calculate the PE ratio for AMD. Number 3, if you have more than one comp, ideally you should have a lot, maybe more than 10. You would take the average of this ratio across all comparable firms or all comps, and then you can infer the value of the firm you're evaluating by multiplying the average ratio from the comps by that firm characteristic. Okay, so in the example here, if you decide to use PE ratio and you want to infer the firm's value, for example, let's say you want to infer the Microsoft's value based on EPS, you would take the PE ratio, average PE ratio of all comparable firms, and multiply that by your observed EPS. And after multiplying that, you should arrive at the firm's price, right? It's a market capitalization implied by the comparables. So let's do an example just to make sure we understand how that's done. if you look at example 5, where we decide to value Fiat Chrysler. Fiat Chrysler is a car manufacturing company, I believe in the US. And say we have two comparable companies, Ford Motors and General Motors. Okay, Ford Motors, General Motors. They manufacture similar types of cars such as sedans and vans and trucks and so forth. And what we want to do is we want to derive the market capitalization of Fiat Chrysler implied by its EPS projection. Okay, so for Ford, we observe its PE ratio, or price per share divided by earnings per share, which is equal to $8.45. For GM, the price to earnings ratio is $7.19. So based on step 1, we're done. We identified two comparables, or two comps, and we already derived the ratio for both of these comps by step 2. So step 3 tells us we should take an average. So let's do that. Taking an average is simply adding these two PE ratios and dividing it by 2, which will give us $7.82. In step 4, we will multiply this average average PE ratio by the projected EPS. So in the question, the projected EPS for Fiat Chrysler is $1.44. What is the value of their stock according to a comparables approach? So let's multiply that number, $7.82, by the EPS of Fiat Chrysler. So that's equal to 7.82 times 1.44, which is equal to $11.28. Okay. So when I wrote this example, Fiat Chrysler was actually trading at $16.20. So what you should be asking yourself, why is there a difference? So as you know, as you probably should infer, there is a difference is because most likely GM and Ford are not exact or precise counterfactuals for Fiat Chrysler. The difference between $16.20 and $11.26, you can argue that it might be a growth issue, a growth difference between firms, but most likely it's because your set of comparables is not large enough to precisely represent Chrysler for valuation. Okay, so there are most likely differences between Ford and GM and Fiat Chrysler, and that's why we get different numbers. But in any case, the point of this exercise of using stock multiples or firm multiples is that if we do come up with a valuation for the firm, finding what P is or what enterprise value is, we can get a back-of-the-envelope calculation very quickly using the multiples method. And using this multiples method, we can come up with a number that hopefully confirms that our model is not terrible, right? Or it's at least meaningful from the fact that it represents comparable firms. All right, so the takeaway from this example is that you should probably get a larger set of comparables and try to rationalize why, most likely including more comparables or throwing away bad comps may actually improve or reduce the difference between the implied price that you get from multiplying this average PE ratio to EPS and the market price of $16.20. Okay, so this concludes our lecture for today. So let me wrap up, summarize what we cover today. So today we discussed the dividend discount model. It is a way to evaluate stock prices using the present value of dividends, right? And we impose many layers of structures, as I explained throughout this lecture, in order to get tractable parameters such that you can actually come up with numbers, right, from real data and input that into your spreadsheet and so forth. The way we did this is we kind of linked the growth path of the dividends with a firm's decision to retain its earnings and allocate that for investments. Okay, and we kind of explored this relationship between investments and growth through its relationship with PE ratios. And finally, we talked about stock multiples and comparables as a sanity check for our stock valuation models. So, of course, we made a lot of strong assumptions, as you know, when we moved from the present value to the stock dividend growth model, and imposing further structure on the growth path of dividends. And comparables allow us a way to kind of to give us a sanity check whether our model is accurate enough, right? A very simple way, right? Simply just by pre-multiplying an average multiple or ratio to some firm characteristic to arrive at some valuation for a firm. Okay. Yes, so I explained some caveats from when formulating these multiples. Your textbook has several examples. The key thing that you should take away is that when you use a particular multiple, you make sure that the numerator and the denominator are characterizing the same parts of the firm. Namely, you should remember that when we talk about stock multiples, we're really only talking about the equity part of the firm. And so the numerator and the denominator have to reflect the same parts of the firm. Okay? It would be a mistake to come up with a stock multiple in which the denominator is actually representing the entirety of the firm, right? For example, a firm might take excessive leverage, and that could definitely screw with these stock multiples. Conversely, if you're talking about the entire value of the firm, you have to make sure that the denominator is capturing something that can be claimed by all stakeholders of the firm. All right, so that's it for this lecture. Next week, we will talk about bond valuation and interest rates. And we will eventually get to the point where we come up with a model for the opportunity cost of all assets. Okay, that's it for now, and have a nice day.